Hey folks, welcome back to the channel. It's Liquid here. And today I wanted to point out this Globe and Mail article about Canadian Tire's warning that consumers are likely tapped out. So a new report from last week, the CEO of Canadian Tire, which is a large retailer in Canada, warned that both their profits and revenue will take a hit. And before they had a goal to grow at 4% a year until 2025, but now they have said that it is not going to happen and they have withdrawn that target. And why does he think consumers are slowing down? He mentions it's due to the 10 interest rate hikes in less than 18 months, combined with the persistent inflation impacting people's lives, and that's what's reduced people's savings and their ability to spend money. He says that Canadian consumers are experiencing increased financial strain and facing tougher spending decisions. And this is what happens when consumers have to tighten their budgets. Canadian Tire's credit card data shows that consumer spending has declined in the second quarter for the first time since 2020. So all the economic stimulus that we got a few years ago, we can see that it's starting to run out now. The company's net income, which is basically its profit, fell to $126 million, while the same quarter last year it was at $177 million. And so you can see the big difference there, from $2.45 per share down to $1.77 per share. And when this news came out about a week ago, on August the 10th, Canadian Tire stock dropped. Here we can see the daily chart for Canadian Tire, and on Thursday, August 10th, you can see it gapped down and finished the day about 4.6% lower. But what's even more telling is since then, look what the price is now. It's at 155, which is an additional 6.3% drop from that previous Thursday. So this is looking pretty bad. The stock did not even go back and try to retest this green 9 exponential moving average. It just continued to fall, which is really bearish for the stock. Canadian Tire investors, at least a good handful of them, are very scared right now. And that's why you don't see any buying pressure. And who can blame them? The stock price represents how profitable a company is, and Canadian Tire is going down in profitability, at least for now. The only good thing if you're a long-term Canadian Tire holder is the dividend yield has now gone up to 4.4%, which is pretty good for a brick and mortar retailer. But I would be careful about jumping into this stock right now because there's a good chance that you can find a better entry point later on. Of course, when discretionary spending suffers, it's not just one company, but it's across the economy. So if we look at other major retail chains in Canada, you can see Loblaws is the biggest one, and that's groceries. People aren't going to stop buying groceries because that's like an essential need. But for discretionary spending, Costco has a lot of that, which is the second biggest store in the country. So if we take a look at Costco's earnings, do we see a similar trend? Let's take a look at COST. Looking at the daily chart, the latest data we have is from the previous earning from May, and that was $2.93 per share. Now, a year ago, in May of 2022, the earnings was 3.04. So Costco made more earnings in the second quarter of last year than this year, which means their earnings have also gone down. Now, obviously, we can't compare Costco to a Canadian Tire. Costco is international. It's also based in the US, but there's a lot of similarities in the developed economies, especially when it comes to consumer spending habits since 2020. So if Canadian Tire is showing how Canadian consumers are feeling, then maybe Costco's recent financials, and especially the one coming up that I think people should pay attention to, can shed more light on consumer discretionary habits in the US and abroad. Now, the stock currently has a PE ratio of 40. I'm not sure why it's that high. It certainly doesn't seem to be growing at a pace that justifies a 40 price to earnings ratio. And maybe the market is starting to realize that now. You can see after it made its previous high over here last month, it went down and came up to make a lower high. So this shows weakness from the bulls. And recently the stock has crashed down to the 50 exponential moving average, this red line here. Now the 50 EMA is generally seen as a trend line. So if this breaks through like the next week here and it fails a back test, then watch out below. And what I mean by failing a back test is it goes down, comes up, fails to go over that red line again, and then it's probably going to head a lot lower. And the back test is important because you can see what happened last time. It fell below the red line, it went up, and in this case, it broke back over the red line and the blue line and the green line. So all the EMAs, and that's what led the stock higher. But when you see instances where the back test fails, kind of like this one, went down, up, got rejected off of the 50 EMA, and down it goes. So Costco stock at this point looks a little bit expensive to me. I think there's more potential for the downside than upside. But if I were to trade this stock, I would wait for a break of the 50 EMA first and then a back test. And then depending on the results of the back test, like if it gets rejected and goes down, then that could be a good opportunity to short this stock or to buy some put options. So I think a lot of consumers are tapped out. We're seeing that from the discretionary sector, and this is largely due to the rapid increase in interest rates. I mean, the prime lending rate at banks right now is 7.2%, and it hasn't been this high in over 22 years. So Canadian Tire's warning could be a canary in the coal mine. I mean, its revenue was down 3.4% from a year earlier. Now, normally this is a single low digit number, not a big deal. But when you consider the fact that Canada's population is growing by like 1 million people every year, then that makes Canadian Tire sales look even worse. Because if the population grows by 3% and your sales are down by 3%, then that's effectively a 6% reduction in people's spending habits. And all of these numbers are in nominal terms, but the revenue that they earned this year is actually worth less than the revenue they earned last year because the annual CPI for Canada was 6.8% last year. So if you factor in the effects of inflation, then like a lot of consumers are really not spending as much as they did in previous years. Just to maintain relevancy as a business, your sales should be whatever it was last year, plus whatever inflation is, plus whatever the population growth is. Because otherwise, as a company, you're losing pricing power, or you're losing market share, or both. So we could be at a watershed moment here. We'll have to wait and see, but I'm not too optimistic about the second half of this year, and especially going into 2024. If you have money in the stock market, it's a good idea to consider diversifying. Some of the valuations I'm seeing in certain parts of the market just seems really high right now, so be careful. In any case, good luck with your investments, and I'll talk to you in the next one.